How much home can you afford to purchase if you make between $25,000 and $50,000 of income using an FHA loan? Now, the reason we're talking about FHA is because FHA is typically the most lenient loan program out there. It allows the lowest credit scores. It allows credit scores as low as 500 if you're putting 10% down, and as low as 580 using 3.5% down. But at the same time, it is also the most flexible with debt to income ratio. It allows you to use more of your income towards debt than any other loan program out there. And as I mentioned a moment ago, you only need 3.5% down with regards to the down payment. So if you're buying a $100,000 home, that's $3,500 down. $200,000, $7,000 down. A $300,000 home, $10,500 down. But at the same time, there's a new loan program out there in the market where you can put just 1% down. And we're going to not only tell you how much you can afford using FHA, but we're also going to talk about this 1% down option as well so that you can compare the two. Now, in this video, we're going to show you how to calculate your income. We're going to show you how to calculate your debt to income ratio. And we're going to be talking about these loan programs in a little bit more detail. But something I want to be very clear on. This video should be used for novelty purposes more so than anything else. Don't take my calculations and run with them and say, hey, I make $50,000 of income and Jeb told me that I can afford X because I meet these requirements. Don't do that. Instead, go talk to a mortgage professional, someone that knows what they're doing, can guide you through the process, can dot the I's and cross the T's and make sure you are actually qualified. If you need that person, I put a link in the description below where you can get a free pre-approval, someone to actually guide you through the process and see how much home you can actually afford. Now, in order for us to figure out how much you can afford to purchase, we need to start with some basic steps. We need to talk about income first. Now, when lenders calculate your income, they're using gross monthly income. That's your income before any taxes. So in this case, when we talk about $25,000 of income or $50,000 of income, we're talking about the number before any taxes are taken out. And the reason lenders use gross monthly income is because everybody has different tax deductions taken out of their paychecks. Some people claim 0 exemptions, other people claim the max exemptions, other people are contributing to a 401k, others are not. So the simplest way to do it is use your gross monthly income. And what we're going to do is we're going to take that number and we're going to divide it by 12. So if we're talking about $25,000 of gross monthly income, that essentially breaks down into $2,083.33 per month. And the same can be said for $50,000 of income. We take that number, we divide it by 12, that gives us $4,166.67. Now, these two numbers are very important because everything else is going to be based off these numbers, your debt to income ratio, as well as how much home you can actually afford to purchase. And whether you're trying to qualify for an FHA loan, a conventional loan, the 1% down loan that I mentioned earlier, everything with regards to calculations up to this point is the same for all of those different loan programs. Now, something to keep in mind, when you're going through the pre-approval process, they're going to ask you for tax returns. They're going to ask you for your pay stubs. They're going to ask you to run your credit because they need this information in order to determine how much home you can actually afford to purchase. So don't be surprised when a lender asks for this information. And something else I want to mention on the income front is if you're self-employed, income is a little bit harder to calculate, right? If you're a W-2 employee, you're a wage earner, you just get a paycheck every single month, it's a little bit easier to calculate because your gross monthly income is on your pay stub, as well as your year-to-date income. And at the end of the year, you get a W-2 that shows exactly how much money you made. Well, on the self-employment front, things are a little bit different. You could make $50,000 of income on your self-employed business, but you might have write-offs, things that you can deduct from your income that results in a lower monthly number. So if you're self-employed, then you really need to be looking at the number after deductions. But at the same time, some of those deductions can be added back into your income. So that's why it's very important to be talking to a professional, somebody that does this daily and can guide you through that process. So what I want to do right now is talk about some calculations. How much home can you actually afford if you make $25,000 or $50,000 of income? But before before we do that, I want to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. Also, feel free to subscribe to the channel to stay updated on everything real estate related. Now, in the past, I've done this video a handful of times, but interest rates were different at that time and I've used different incomes. In fact, I filmed this video back in June of 2021 and interest rates at that time were 2.25%. In fact, I did a similar video on incomes between $50,000 and $75,000 back in January of this year, and interest rates were sitting somewhere around 5.75%. But today's video, interest rates have moved up a little bit. So in today's calculations, we're going to use FHA rates at 6%. Now understand, you might be watching this video at a later time and interest rates might be higher than that. They might be lower than that. Interest rates move every day. In fact, they move a couple of times a day. So just make sure when you're hearing these numbers, you're comparing it to where rates are today so that you know you're getting accurate information. So earlier in the video, we determined if you make $25,000 per year, that basically breaks down into $2,083.33 per month. Well, FHA allows a max back-end ratio of 57%. What is your back-end ratio? That means your mortgage payment, the taxes, the insurance, the mortgage insurance, everything associated with that home. If it has an HOA, that's included as well, on top of any monthly debts you have. If you have a car payment, if you have credit cards, if you have student loans, all of those things cannot be more than 57% of your gross monthly income, which in the case of $25,000 annual income, those total debts cannot exceed $1,187.50. But at the same time, FHA also has a front-end debt-to-income ratio, and that cannot be more than 47% of your income. So what is the front-end ratio? Well, that's just the housing expenses. So that's the mortgage payment, the property taxes, the insurance, the mortgage insurance. All of that cannot exceed 47%. So in the case that you make $2,083.33 per month, your mortgage payment cannot exceed $979 per month with all of those things included. Now, with that said, if you have no debt, you're absolutely good at that number. If you have monthly debts like car payments, credit cards, student loans, that sort of thing, they can't be more than 10% of that gross monthly income using these numbers. Otherwise, you're going to exceed that max debt to income ratio of 57%. So in the case that we're running numbers today, we're talking that a front end ratio can't be more than $979 and you can't have more than $208 of monthly debt. Now, when I say monthly debt, if you have a $5,000 balance on your credit card, that's not the monthly payment. Maybe the monthly payment is $25 or $50 or $100. And in this case, you've got up to $208 of monthly debt that you can have where these numbers are still accurate. So now that we know your max monthly payment that you can have, let's talk about a couple of purchase prices and figure out if you can afford to buy those making $25,000 of income. So if you bought a $100,000 home, using FHA, that's a 3.5% down payment. That means you have to put $3,500 down, which means you're financing $96,500. But there is an upfront mortgage insurance premium that FHA has. It's 1.75% of the loan amount. They add it on every single loan, regardless of your credit score, regardless of your down payment. It's just part of the process. And in this case, it would be $1,133. So what we do is we take that upfront premium, we add it back to that base loan amount of $96,500, which means the amount that we're actually financing is $97,633. Using today's interest rates of 6%, that gives us a mortgage payment of $585 per month. On top of that, you're going to have property taxes. I like to use the annual property tax rate of 1.1%. Now, I realize some states out there like Florida and Texas have super high property taxes. So if you're in a state that has higher property taxes, you need to factor that into these calculations, because chances are you're not going to be able to afford quite as much home if you have those higher property taxes. But based on 1.1%, your property taxes would be $91.67 per month. In addition, you're going to have monthly mortgage insurance, something that every single FHA loan requires. Again, regardless of down payment, regardless of credit score, that's going to be 0.55% in this case, which is going to equate to $45.83. On top of that, you're going to have homeowners insurance that you have to pay every single month. That covers things like fire, theft, that sort of thing. And based on a calculation of 0.0035%, that means you're going to be paying roughly $28.15 per month. So all in, including all of those things, your total mortgage payment would be $751.01 on a $100,000 home, putting just $3,500 down. Now, earlier when we broke down the income and we said the max you could put towards a mortgage payment was $979. So in the case of a $100,000 purchase, you should be able to make that work. Now, earlier in the video, I told you, don't use these calculations as the gospel. Make sure you're talking to a mortgage professional to verify this information, to verify your income, verify that you're doing everything correct to make sure that you're good to go. If you need that referral, again, there's a link in the description below. So you can qualify for a $100,000 home, but can you qualify for $150,000? Well, in the case, again, that you're doing FHA, that means a down payment of $5,250, which gives you a base loan amount of $144,750. Once we add the upfront mortgage insurance premium of $1,700, that gives us a new base loan amount of $146,450, which is actually the amount that we'd be financing. At an interest rate today of 6%, your mortgage payment would be $878 per month. On top of that, you'd have property taxes of $137.50, mortgage insurance at $68.75, as well as homeowners insurance at $42.22. So all in, your total mortgage payment would be $1,126. Now, if you remember earlier, our max loan amount at a 47% front-end ratio was $979. So in the case of a $150,000 home, we would not be able to purchase it using an FHA loan, putting just 3.5% down. Now, if you're watching it up to this point and you're wondering how the 1% option changes things, well, in today's video, when I talk about the 1% option, I'm talking about the Rocket Plus mortgage. I'm not talking about the other one out there with UWM because it's a little bit different, and I want to talk about Rocket Plus because there's no mortgage insurance, right? The lender is actually covering that mortgage insurance, making it more affordable for the buyer. So in the case that we go back to that $100,000 home, if you're doing the 1% option, unfortunately, the interest rate is going to be a little bit higher. It's going to be somewhere around 6.875%. That's the number I'm using today that would more or less equate to the same credentials as a buyer that we're talking about on the FHA side. So when we're talking about the $100,000 purchase price, instead of having to put $3,500 down, in this case, you're only putting $1,000 down because the lender is covering the additional $2,000. So up front, you're already $2,500 ahead in what comes out of your pocket. But here's the thing, because the interest rate is higher, you're actually going to be paying more on that mortgage payment. It's going to equate to just over $637 per month. Now the property taxes stay the same, the homeowner's insurance stays the same, but you eliminate the mortgage insurance with that 1% down option. And overall, you end up with a mortgage payment of $756. That's about $5 more than the FHA example that we mentioned a moment ago. So it's only $5 more, but you came in with $2,500 less than you did with the FHA. So in my eyes, that's probably a better option. Now with the 1% down option, there are other requirements that you have to meet. You have to be less than 80% of the area median income. Now, if you don't know what that means and all those calculations, I just did a video on it that I'll refer to you right here if you want to go check out that video on the 1% mortgage and get more information on it. But either way, I'll put a link in the description below where you can figure out the area median income of where you're looking to purchase. Now, it's a similar story when it comes to the $150,000 purchase. If you're putting just that 1% down option that we mentioned a moment ago, you're going to be paying more on the monthly mortgage payment and a little bit more on the total overall mortgage payment. But in the case of $150,000, you're only putting $1,500 down versus the $5,250 that you were putting down earlier. The lender is covering the remaining 2%. So you're only coming out of pocket with $1,500 plus any closing costs that you have, which we're not factoring here, but up front, it's already a less expensive loan. And your mortgage payment's only about $8 more per month because it comes to $1,134 versus the $1,126 of FHA that we did earlier. So overall, it sounds like the 1% down option is a better option if you can qualify for it. Now, some of the restrictions out there are a little bit tougher than that of FHA because they limit your income and that sort of thing. So just make sure, you know, when you're talking to a lender, you have them compare both options side by side and you can determine, you know, exactly which one is best for you. You can see the total monthly payments, you know, which one is less or what have you. You can see total out-of-pocket expenses. And from there, you can make an informed decision. Now, lastly, what I want to do is talk about $50,000 of income. Earlier in the video, we mentioned that breaks down to $4,166 per month. Now, if we're using the front-end ratio, which I mentioned earlier, with a max of 47%, that means we can't spend more on our mortgage than $1,958 if we're using an FHA loan. Now, with that said, we could have up to $416 in other debts and still qualify for this loan because they allow a max back-end ratio of 57%. Now, if you forgot the front-end ratio and the back-end ratio, go back and listen to that. The front-end ratio is just the housing expense. The back-end ratio is your housing expense plus any other debts. So the magical number here is $1,958. So if you were buying a $200,000 home, could you afford it if you made $50,000 of income? Well, again, in the case of FHA, buying $200,000, that means it's going to require a down payment of $7,000, which means you're going to have a base loan amount of $193,000. But you are going to have that upfront mortgage insurance, which again is 1.75%, which equates to $2,267. So our new base loan amount, the amount that we're actually financing, is going to be $195,267 at a 6% rate. That's going to give us a mortgage payment of $1,170. Again, we're going to have property taxes, which are going to equate to $183.33. In addition to having monthly mortgage insurance at $91.67 and homeowners insurance at $56.29. So all in, our monthly mortgage payment would be $1,502. So in the case of $50,000 of income, you should be able to qualify for that home unless you have a bunch of other debt. And in the case that we compared it to the 1% down option, the biggest difference here is that you have to come in with less money. Again, you'd be putting in $2,000, the lender would be putting in the other $4,000. You would eliminate that mortgage insurance, but you'd be financing at a higher interest rate, which in the case that we used the same examples earlier, your payment here would be about $12 more per month, but you're saving $4,000 up front by not having to come in with that additional 2% down payment the lender would be covering. And the last thing I want to do, can you qualify for a $250,000 home if you make just $50,000 of income? So instead of going over all the numbers again, the total payment for that $250,000 home is $1,877 using the same calculations that we've used throughout this video. And if you remember, we had $1,958 that we could use towards that mortgage payment, which means that you should be able to qualify for that $250,000 home if you make $50,000 of income. Now, if you're watching this going, Jeb, I make $50,000, maybe I make a little bit more, maybe closer to $55,000 or $60,000. What do those numbers look like? Do me a favor and check out this video here.